And good morning, April 22nd. We have no positions on, and I'm going to make this video a little bit different. I wanted to show you a couple things. Um, Really, it has to do with what's going to happen in the stock and bond markets, possibly for the next 5 to 10 years, who knows? But, history is very clearly repeating itself, and the conclusion I've come to um, during the 1970s for about 10, 12 years, we had stagflation, we had high inflation, high interest rates. The stock market went sideways to down, and bonds, um, well, they raised interest rates. So when interest rates go up, bonds also go down. So the entire um, uh, investment landscape, investment opportunities for 99% of the investors in America, stocks and bonds, namely, Um, well, it's not going to go well for you, um, unfortunately. We have an irresponsible group of people that run the Federal Reserve. Well, we shouldn't have a Federal Reserve, but we don't need to get political. Just need to show you the facts. This is a log chart, logarithmic chart of the stock market. Well, going back to 1930. So here's this peak here about 1968. And here's this low point about 1981. That's about 12, 13 years where the stock market went down. And that's during a time of inflation. So during inflation, raw materials and commodity prices go up and everything goes up in price when there's inflation. But corporations that buy raw materials, they raise their prices eventually, but they're behind the curve, because the raw materials prices go up and the consumer won't accept higher prices um, so quickly. It takes time to raise prices. And of course, people's paychecks buy less and they make less money and there's less jobs and all kinds of problems. But that's what's coming. We'll see if they try to uh, divert our interest from what's going on in the financial markets with another 10-year war. Um, but that's what happened. Um, let's look at the bonds. So this is not the price of bonds. This is the interest rates, which moves inversely to bonds. So if this is going up, that means bond prices are going down. So you can see here, here's 1970 here. Okay, so their bond prices, once we look at the same period, 1969, 1970 to 1981 is here. So we see interest rates going through the roof. So credit cards, mortgages, you're not going to be paying 4% for a mortgage. You're going to be paying 20% for a mortgage. They finally, the politicians finally realized there's no more lying and trickery and games and everything. You have to accept higher interest rates, because if you don't do it at the Federal Reserve level, then the market will do it itself. The nominal prices may not reflect it as much, but the actual prices, when you include inflation, inflation rates uh, are through the roof and will continue that way. And it takes a long time to undo that. But you see this peak in interest rates, which is a low in the bond market. And then we see this from 1980 to 2020. So this is 40 years interest rates went down. A lot of that's just the wealth that accumulated. A lot of it is because America became so wealthy. We spend, 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 spend. We import, import, import. We buy from other countries, and those other countries in turn kindly buy our investments in our country and park our money in our bonds and stock markets. And you could see that this trend down changed. And it's even more apparent on this chart. Now, this only goes back to 1980, but here's your low in the bond market. This long trend. By the way, this very top, this is the coronavirus scare, and that is the all-time high we will ever see in the bond market. This trend line was broken back in 2022 and has not recovered. So this is going to go back. This will go back to normalcy. It's going to continue down, but no more free lunch. Um, and they're going to, politicians will use trade wars and terrorists and Trump and whatever to propaganda. The news propaganda is going to blame it on this, that, and the other. But in the end, it's the Federal Reserve and the $100 trillion in wealth they've stolen from the American people and uh, people of the world. They do it. They steal from people in every country that has a central bank run by the same group of bankers. By the way, the only countries that don't have that are North Korea, Iran, and a handful of tiny countries in the Middle East. There's a few others around, and that's why we're constantly beating the war drum against those countries. They're not in the central bank uh, reserve system. But anyway, so there's going to be 10 years of, we're not going to be so wealthy. All the money's been stolen. All the savings have been stolen. You know, if they didn't print the currency, did you know that you'd have to work maybe 10 years of your life? And then whatever money you saved, you know, if it was in a, I say stable currency, where they never printed the currency, let's say gold, for example, you'd be able to retire because just by the virtue of the population growth, the demand for the currency would go up, and the actual value of the currency you're holding would just year after year just go up and increase. But that's what happens when you have people stealing hundreds of trillions of dollars from the people of the world, is you end up slaves and you always work for those people. But they can't do it indefinitely, and eventually it catches up to them. So we're at the end of that era. So just to show you in these charts, so what's interesting to me right now, and showing you how weak the bond market is. So here, this bottom one is the stock market. This is the 2009 financial crisis. You see this big red cell, and here you can see the bonds shoot up here. So you've got this. I'm just asking you to eyeball this. It shoots up, right? You've got this huge move up during this financial crisis. Here's September 11th, right? So here's the sell from September 11th, right? And here's this corresponding move in the bond market. And you see this is an overall uptrend, but we see this huge reaction from the bond market to these financial crises, or in this case, this September 11th event. Let's go to coronavirus. Here's this coronavirus dip, and here's this coronavirus rally, and you see this all-time high, and you see this uptrend. And that was the end of it, and it's been down ever since. Bonds have been going down. So I just showed that on the other charts. So this is sort of showing the same thing. Um, and, well, you could see the stock market here. It's not too apparent, but if you eyeball a little bit, I think you can see, you know, draw trend lines, but we've had a good run here, and especially since the 70s and the 80s, or since 1981. But we've run out of gas, and this is just the beginning. And it's just the fact that we have printed the crap out of the currency. And well, I didn't pull this up yet, but monetary base. see if this pull chart quick. Look at this. The adjusted monetary base. Look at this. Starting in 2009 financial crisis. You know, I mean, I mean, is this a bubble? Have you not seen such a dramatic bubble? You know, let's go 10 years. So, well, this doesn't even show 2020. It doesn't go to 2020. They don't want to show you anything beyond that. But um, we've gone 5 times over what the monetary base is pre-coronavirus. Here, this will show it, I think. Yeah, here we go. So here you've got this 3 trillion monetary base in 2020. Which one is this? This is the total monetary base. Well, anyways, we're up here, 6,000. So it's doubled. This is the economy, it's the monetary base. I think, look at M2. Here we go, money supply. Isn't it amazing? The Federal Reserve won't even show you past 2019 on their charts on their website because they don't want you to see what happened. Um, yeah, so let's say 10 years here. So, anyways, you can see this dramatic increase in the monetary base post uh, coronavirus. So, anyways, this is just a continuation of, and they don't want to show you M1 anymore. Yeah, okay, this is the one, M3, sorry, M1. So here we're at 4.7 trillion. Um, we're now at 18 trillion. So four and a half times they printed the money. And it takes time to work through the economy. That's since 2020. So prices are going to increase 4 times over. And it takes time, years for that to work its way into the economy. The government spends the money and gives it to their friends, gives it to the billionaires, and it takes time for that money to leak out into the economy. But eventually it does. So anyways, that's what's happening. We're not no more money, no more free stock market money. If the stock market does go up, when it does, it will be um, on the back of massive inflation and loss in buying power. Interest rates are going to go through the roof, and it's just taken a long time. Everyone knows this is going to happen. I mean, this has been predicted since the time went to business school 25 years ago. But we've just been waiting. That's how long it's been taking. Everyone knows that. Ever since Alan Greenspan and his friends, and he made the famous statement, "Oh, well, we always need to have some inflation because we don't know what happens when you have deflation." It's very simple what happens when you have deflation and the market corrects itself quickly. The people take their turn becoming wealthy and their value of their savings goes up. Um, and the economy returns very quickly back to normalcy. The businesses that didn't manage their businesses well go out of business because the interest rates are high. But low interest rates help poor performing companies and these global corporations, which are very inefficient, but they still have monopolies to compete with and drive out of business the smaller companies that are actually providing good customer service and so on and so forth. Anyway, so that's what's going to be happening, and it's just these things take time, and these markets always bounce around. Years and years ago. So here's the gold market. Years and years ago, when I was trading in the early trading experiences. So in 2006 here, there's this rally in gold. And if you look at this whole chart, which is not a logarithmic chart, it's one of the reasons it looks so crazy big, but you just see this little run, this little guy here in 2006. So I think I turned about $3,000 into about 30,000 during this rally. And I probably lost most of it on the collapse, but this is just a tiny little thing. Now, when I graduated college and became a little bit more professional and serious about it, this run here, not just gold, silver, and a handful of other commodities, but this was a period of time where, well, I think first I turned 20,000 to 200,000 in copper. Then I went on vacation and left it be and didn't get out, didn't take any profits at all, and let it go all the way back. And lost most of it. I think I ended up with 30,000. I was through with 20,000, I ended up with 30,000. But that was up to 200,000. But then this is the one where I did it full time and I got a commodity portfolio. And I made the same mistake. Um, but it was only this little sell off here that happened in March of 2008. But I rode this, you know, maybe I started with 200,000 while it was rallying and going up. I pulled the $200,000 out, my original investment out, and then I wrote it and gold and silver, a bunch of things. I got to 1.2 million up here before it collapsed, and I ended up after the collapse with about 400,000 left out of 1.1 million. So I still went from a account of 200,000 to 600,000, but and then I proceeded to lose a lot of that and making trading mistakes after that. But this was the long-term trend following that works. And look at this huge move. It just took longer and it was much choppier rather than this straight shot. But this chop, 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 because we had this financial crisis in 2009 and so on. But anyways, we got this, look at it go up. So we have an increase around here was about $250, $275 an ounce. So in 2000, and this ended about 2012. So 12 years, it went from 275 to about 1900 is the peak here. Came back down to 1300. So 2012, 2011 really is when that peak happened. And then we've got here. It first broke and tried to get above 2000 here, 2020 during coronavirus, but didn't make it. So we just had this finally broke out. So this is 2024. So although this chart, because it's not logarithmic, just looks, these little moves just look tiny compared to these astronomical moves. It's the same. It's the same. We're just dealing with a different monetary base. We've just inflated a lot since then, but these rallies here, and each one of these bars, by the way, represents a month. I mean, this is really, you look at these things, each one of these is 1 month. So you can see it goes on for a long time. When you use leverage, but when you use leverage, you have to be a trader because you have to be smart and you can't ride these rallies down. You've got to be good and sort of know when the momentum runs out of gas and when to get out and when to get back in and so on. These opportunities abound, but these breakouts here, this is where we're at now. Okay, this is in fact this is where we're at. right? New highs. Okay, so here's this. This is the all-time peak prior to 2008, and it was back in the 1979. And it went to 800. And this is they don't show you the beginning of this, but it went to 35 from $35 in 1970 something to 800. So when it broke above 800 was a big deal. You could see here 2007, 2008. So it took about 25 years to make a new high. Well, here we are again. Look at this. It's funny. We actually have these, periodic breakouts and retest. And here we are again in this breakout. So we settled down with the low interest rate environment and good growth environment for this period of time. And then we pushed at these highs again, and here we are. So this breakout above this 1900 area, this 2000 area, which went on for 12 years, 2011 to 2024, and we're shooting up now. So my point is we're here. This is where we are. Okay, so this is 500. This is like 600. This 800 is up here. So from here, one, two. By the way, the Federal Reserve is much more irresponsible now than when they even were back here. People are tolerating a lot more. Took 2 years. And then took 2 years it waited through the 2009 financial crisis and then shot up again. But anyways, you can see it fairly quickly doubled in price. So if we're breaking out of 2000, or here we are at, 3000. So we're at 3500 now. So let's look at gold. So let's pull up a chart of gold. Here's the monthly chart. Here we are again. And you can see this. There's the peak in 2000 I was talking about, or I mean 2011. And then it tried a couple of times to get above it, and then there's this breakout. So we're just at the beginning. Now that's a monthly chart. Each one's a month. So here's the daily chart. Here's the Trump tariff crisis. And this is 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 days. This has been going on for 9 days. So if you think there's not, I think you missed the run in gold. You have it. There's 9 days of this. You it's just the beginning, and it's going to be that way for a lot of commodities. Of course, every market, gold included, goes through their cycles within these commodity boom bust. With the rallies and the sell-offs, just the entire volatility, just the trading opportunities just go through the roof. There's just so much money to be made. So much money to be made off these moves. And stuff, all it takes is just stuff for stuff to move. You just gotta, you just gotta look for those opportunities. And when we're in these certain types of environments, you just sit there in the stock market and you just watch the stock market go up for years. You make a lot of money, but that's going to end. And stock and bond investors aren't going to make anything. And it's traders like me that can trade these trends in and out that are just going to make a killing. So that's the plan. That's the plan. Um, what else I want to show you? Here's the bonds. Oh yeah, this was the point. I'm going to show you the bonds. So the last thing I'll show you, but it's hilarious. It's absolutely so. There's your 2009 crisis, and there's your rally in the bond market. Just to eyeball it to see this astronomical move. There's your astronomical move in coronavirus. 2011. There's your September 11th rally. There's your September 11th rally. right? Coronavirus. This is the Trump sell-off, Trump tariff sell-off, right? Look at how big it is. It's just as big as the other ones. Not as big as the 2009 one, but 2000, 2011, here's your coronavirus. I mean, in terms of the amount of time it's going down and everything else, it's fairly similar. Um, this is the tariff rally. In other words, no rally. I mean, this is the best they can do, this little bounce here. That's your bond. In other words, bonds are so weak, fundamentally so weak, there's no rally. There's no crisis rally. Every other time the stock market's had these dips and these crisis rallies, the bonds shoot up. There's no rally. This is the monthly chart, but see this little wick here? That was it, and then it went back near the lows. No coronavirus rally, no financial crisis rally, just this little wick up. And I'll show this to you on the daily chart, just sort of show you. So here's the Trump tariff crisis rally. Yeah. 1, 2, 3, 4, 5, 6 days it could go up, and then got slammed down and ends up lower than where it started. In other words, bonds are so weak they can't even sustain a crisis rally. So these are all indicators just to show that interest rates are going through the roof. They'll kill the stock market. All the all the companies borrowing money, all the company using raw materials, they all have to buy raw materials to make their products. Commodity prices are going to go through the roof. So the stocks are not going to do well, and they're overpriced right now. They're like 30 and 40 times price earnings ratios, which is historical high, which is the point that they got to when the stock market tech bubble bust. That's how high they were. So things aren't looking good. Um, so just making a case for not investing in stocks and bonds, but rather, um, well, you could take a small position in gold if you know how to manage it and you'd do all right, I think. But you can see how choppy it is. But making a case for um, trading for me to trade, and I'll have other videos to show my performance. But that's the bottom line that I wanted to share with you.